On June 26, 2002, the New York Stock Exchange halted trading in Adelphia Communications, a once thriving cable giant, after a sudden flood of disclosures revealed that the Rigas family had siphoned billions of dollars from the company's coffers, turning a public utility into their personal piggy bank. Adelphia, founded in 1952 by John Rigas in Coudersport, Pennsylvania, began as a modest collection of cable franchises serving rural communities. By the early 1990s, the Rigas brothers, John, his son Timothy, and later his other son, Michael, had built an empire that stretched across 30 states, delivering television, internet, and telephone services to millions. The company went public in 1996, raising capital that fueled rapid expansion, and its stock surged, rewarding shareholders and cementing the Rigas name in the annals of American entrepreneurship. Behind the glossy press releases, however, a different story was unfolding. The Rigas family controlled Adelphia through a labyrinth of holding companies and secret loans. They routinely borrowed against future earnings, using the company's own assets as collateral, then diverted the cash into personal investments, luxury homes, yachts, and even a private jet fleet. In 2002, internal auditors discovered that more than $2.3 billion in undisclosed debt had been hidden on the balance sheet, a figure that dwarfed the company's market capitalization at the time. The revelation sent shockwaves through Wall Street. Investors who had trusted Adelphia's growth story saw their holdings evaporate overnight. Employees, many of whom had been promised lifetime jobs, faced layoffs and uncertainty. Regulators, led by the Securities and Exchange Commission, launched a sweeping investigation. The SEC's complaint alleged that John and Timothy Rigas had engaged in a systematic scheme of fraud and deception, using false financial statements to inflate stock prices while secretly enriching themselves. The trial, which began in January 2004, unfolded before a packed courtroom in the U.S. District Court for the Western District of Pennsylvania. Prosecutors painted a stark picture: a family that treated a publicly traded corporation as a revolving door for their own fortunes, betraying the trust of shareholders, employees, and the public. They presented mountains of evidence, emails, internal memos, and bank records, showing that John Rigas had approved loans to entities he owned, then used the proceeds to purchase a sprawling estate in the Hamptons, a private island in the Bahamas, and a fleet of exotic cars. Timothy, the chief operating officer, was shown to have authorized the same transactions, concealing them from auditors and the board. The defense argued that the Rigas brothers had acted in good faith, asserting that the loans were legitimate investments intended to strengthen Adelphia's long-term growth. They claimed the accounting irregularities were technicalities, and that the family's intent was never to defraud. Yet the jury, after a grueling 6-week deliberation, found both John and Timothy Rigas guilty on multiple counts of securities fraud, wire fraud, and conspiracy. The verdict sent a clear message: even the most entrenched corporate dynasties are not immune to the law. Sentencing followed swiftly. In June 2004, John Rigas received a 15-year prison term, while Timothy was sentenced to 20 years, both substantially higher than the federal guidelines, reflecting the magnitude of the breach of trust. The court also ordered the forfeiture of nearly $1 billion in assets, including the Rigas family's luxurious properties and private aircraft. Michael Rigas, though never charged, faced civil suits that stripped him of his remaining stake in the company. The fallout extended far beyond the courtroom. Adelphia's once glittering brand crumbled, and in 2005 the company filed for bankruptcy, the largest cable television collapse in U.S. history at that time. Creditors, shareholders, and employees watched as the firm's assets were sold off piece by piece. Cablevision and Comcast acquired the remnants, rebranding the networks and integrating them into their own operations. The scandal also sparked a wave of regulatory reforms, prompting the SEC to tighten disclosure requirements for corporate debt and to increase scrutiny of related party transactions. For investors, the Adelphia case became a cautionary tale taught in finance classrooms across the nation. It underscored the importance of corporate governance, independent board oversight, and vigilant auditing. The Rigas brothers' downfall served as a stark reminder that when a family treats a public company as a personal piggy bank, the eventual reckoning can be swift and severe. In the years that followed, the Rigas saga continued to echo. John Rigas was released from prison in 2016 due to health concerns, and Timothy's sentence was later reduced after a successful appeal, but the damage to their legacy remained irreversible. Their story stands among the most infamous corporate frauds of the early 21st century, alongside Enron and WorldCom, each a testament to how unchecked power and greed can erode the very foundations of trust that underpin the market. As the dust settled, the lessons of Adelphia persisted. Investors now demand greater transparency, regulators enforce stricter compliance, and boardrooms across the country have instituted more robust checks to prevent a single family from wielding unchecked control. Yet the temptation to blur the lines between personal wealth and corporate assets never fully disappears, making vigilance essential. The Rigas family's rise and fall reminds us that the allure of quick riches can blind even the most seasoned entrepreneurs to the ethical boundaries that separate stewardship from exploitation. Their story, captured in the annals of corporate crime, serves both as a warning and a catalyst for reform, a reminder that the health of a public company depends on the integrity of those at its helm. Subscribe to The Verdict for more stories like this.